FedEx shares enjoying gains this morning. That's after the company promised more aggressive cost cuts as declining volumes weigh on margins. We're here to add some perspective on the company as Bank of America Global Research Senior Transportation Analyst Ken Hoexter. Thank you for joining us this morning. So I want to get your takeaways because this is another round of billion-dollar cuts on top of what they'd already planned for September. What are your big takeaways from what this really signals for the company?
Great. First of all, Kiko and Rochelle, thank you very much for having me and happy holidays. What the billion-dollar cost cuts really indicates is first, the $1 billion represents about $3 of earnings per share. So they set a target of $13 to $14. That's down from, remember, almost $24 they were targeting before they pulled their targets back in September. So just to put on scale how much things have changed, it tells you that volumes were quickly kind of falling apart, decelerating on an accelerating pace. Or declining at an accelerating pace, and then and it tells you that they're making moves to cut costs very aggressively, right? So they've set now a $3.7 billion target of cost cuts, up from 2.7, adding that extra $1 billion, and that's how they set this $13 to $14 EPS target. But they're making these moves because volumes are coming down so fast. But finally, they're taking steps beyond just keeping pace with the cyclical change. They're talking about the structural changes. And that's really what's key for FedEx. That's what investors are looking for, is kind of some structural changes that will pull real costs out of the business. And that's kind of what they were talking about with that $1 billion of additional costs to really get the enterprise back on track.
The declining volume there, as you point out, is cyclical, not specific to FedEx, but the rate with which it's decelerating, how much of that you think is a FedEx specific story, and how much worse is that likely to get?
Well, it's a great question. I think last quarter we heard about a lot of, FedEx even commented that UPS and DHL were eating their lunch in Europe as they were just finishing up their integration of the former TNT with FedEx Europe. I think now part of this is really, general economic impacts, particularly out of Asia with China shutting down for as long as it did during the quarter. I think you saw that. We were just out at UPS. They talked about the impact from Asia. So I think that's more broad-based. I think domestically, it's not really about share gains and losses right now. It's really the economic backdrop, as the CEO, Raj Subramaniam, talked about. It's really more about the lack of e-commerce, right? On a comparable basis, where you had it run up as such a huge percentage of retail sales, it now coming down more toward historical or where it was pre-pandemic levels, still a little bit higher. But I think that's really what you're seeing. And that's kind of the core business that had run up. And that's kind of what's pulling back now. But again, FedEx, for the first time in 20 years, gave us monthly statistics on volumes, and you're seeing them decline at an accelerating pace into the end of the quarter. I think that's the key that we should all take away, is things are still ugly and progressing even worse in terms of a volume environment.
And you mentioned, obviously, when it comes to the express business, it was Asia and Europe really being the most drag there. What are your expectations then domestically versus, say, internationally for FedEx?
Well, domestically, we heard the rails talk about parcel volumes on the railroad being down about 15% in terms of, UPS moving from the West Coast to the Midwest. That kind of mirrored what we heard. If you look at what the breakdown of FedEx into their domestic side, you're seeing down mid-teens. So those are pretty strong levels on a domestic parcel level. So when you think about U.S., ground volumes were down 9%. We were looking for down 4%. Freight volumes, that's the kind of LTL, less than truckload portion of their business, also down 9%. So you're seeing close to double-digit declines and accelerating to the downside. So that highlights that backdrop of the e-commerce, as well as kind of just the core economic activity still on the weaker side.
Ken, you mentioned China being a big overhang in terms of demand for FedEx. You've got a lot of bullish calls out there from analysts who are saying the demand is really going to accelerate once China begins to sort of opening up really picks up pace. It's already underway. What's your outlook on that front, and how significant is that demand likely to be come spring, for example?
Well, that's a huge opportunity, but you also just missed a huge opportunity, right? Which is peak shipping season. Peak shipping season is that holiday season, call it from Thanksgiving till Christmas, when you see a lot of retailers making up a large portion of their shipments. We had a very, very muted peak shipping season. And so now you've got to move into the new year, into that. We still have high inventory levels in the system. We do a truck shipper survey every 2 weeks. We just hit the highest level of inventories in our dozen plus years of doing this biweekly survey. So when you think about the high level inventories, we obviously have some stuff to work through in the economic system. And with demand being down, it's just going to take a little bit longer. So as China ramps up, certainly a huge opportunity, one, for the sales overseas, and then, within Asia, and then obviously for the transborder shipments that become a big part of the profitability growth driver. We've got to work through some inventory. So as you mentioned, it depends on your time frame through the year. The later you go, obviously, then the more bullish it is into an economic rebound. But we are certainly working through those very high inventory levels over the next few months.
Yeah, a lot of companies betting on that rebound coming out of China. Ken, it's good to have you on today. Bank of America Global Research Senior Transportation Analyst, Ken Hoexter.